Good evening, everybody. Unlike others, we're not late. We're early.
I know. Oh man, I wish I was a little later to get some more sleep. But
Yeah, sleep
let's
would be nice.
yeah. So everyone, welcome to the first ever. What are we calling this thing again? I think we came up with like 5 different names before we settled on something.
Inside the numbers.
Inside the numbers. There you go. That's the one. Welcome to Inside the Numbers. Basically, guys like me and Steve, who are doing horribly on the stock draft, by the way, we were talking about this. We invest a lot based on some good, strong fundamentals for companies. And sometimes it works out, sometimes it doesn't work out so well. But most of the time, long term, we tend to invest in businesses that are undervalued or things that people are not recognizing. And there's actually fundamentals behind it. You know, we've been in this market long enough to know that there's a lot of times where companies come around, they're all hype. There's no real way that they can ever really make any money. And sometimes the market just gives them a little bit too much credit. And when the market does that, it causes a lot of people to FOMO into it. And once they FOMO into it, it's too late. And then they're basically bag holding for the next 5, 10, sometimes forever. So we are going to try to do a little bit something more different, where we are going to talk about companies, and a lot of them are going to be your run-of-the-mill boring companies that, you know, a lot of people are going to say, wow, I don't want to invest in some company that only grows 7% or 8% or even 10% per year for the next 15 years. That's slow. I want to get rich instantly. And to that, I say this probably is not going to be fun times for you, because we are not about getting rich instantly. Me and Steve, without really like revealing our net worths to everyone here, we have done extremely well in our portfolio, in our personal lives. And one of the ways that we've done it is that we've been able to sustain our growth for multiple decades, right? So me and Steve, we're probably among our friend group, like Amit, Tanner, Matt. Compared to me and Steve, these guys are all babies. They haven't seen what a real downturn looks like. And so a lot of times that lack of fear makes them a lot more bolder. For me and Steve, we've lived through '08. I've technically lived through '01. So we've got a little bit of an
Like this.
appreciation. So
Chris and
that
I
again?
are old. We are old.
Yeah,
That's
we're
all
old.
we're saying. You're old.
Yeah. So don't let this freshly shaved baby face fool you. I'm actually 40 years old, you know. So, and I've been investing for quite some time. So I've had my fair share of ups and downs. And one of the things that you realize is when you invest long enough, you'll see that there are pockets of opportunity that are worth looking at and worth investing in. There are methods to investing in things like this. But then once you get to a certain wealth level, you know, the goal isn't necessarily about adding more to the bottom line. It's about preserving your wealth. And that's something that me and Steve have been able to do successfully over the last, 20 years of investing. And so hopefully we can kind of like talk to you guys about certain fundamentals that we've learned over time and how we've been able to outrun the market. And periods like this, and I think this is really perfect, where valuations on pretty much the entire market have gone pretty much parabolic, the chances of any sort of downturn are exaggerated. So you kind of want to have a little bit of a portfolio that's based more on value and fixed income than just your run of the mill. Hey, I think I'm going to invest in this one company that's going to have a product in the next 10 years. But right now, everyone is valuing it like there's a product that's pretty much generating money right now. So the market currently that we're in right now is very, very rich. And so me and Steve, if you're thinking about like a poker, not poker, like going to Vegas. But watch, by the way, me and Steve are actually degenerate gamblers too. So we were discussing
I wouldn't
craps
go that
ideas.
far.
Yeah. We were talking about craps ideas. We're the type of guys that it's about 12:30, 1 o'clock, and we're the guys that are saying, hey, let's go back to our hotel rooms and count our money. Okay. So if you want to listen to a couple of old geezers who've been in the trenches long enough that are actually going to help you get out of Vegas with some money in your pocket, welcome to the show.
Yeah, and what I want to say about inside the numbers is a lot of people just look at top line growth, and top line growth is great. It's very important, but there are other things to look at that people take for granted or overlook or don't account into the situation. And when pockets of the market get too rich, sometimes there's hidden value under other places and there are screaming buys. And one company that comes to mind is Altria Group. Nobody liked it. It was trading at a valuation where it was yielding 9-10%, and it was an absolute cash cow. Altria Group's gone from 40 to 65 or so. So there are diamonds in the rough out there that are not necessarily going to be a high flyer that's going to triple or quadruple your money, but you're going to get paid to own it through the dividend. And there are other things than companies geared toward top line growth that can do well and help balance out a portfolio.
Yeah. And now also, there are times where things get oversold, right? And there's fundamental reasons why things are oversold, and they also present great opportunities for great return. And the thing is, it's not something that you have to necessarily babysit every day. There are certain stocks that literally, I know I ask people like, hey, listen, why are you in this? He's like, oh, this thing's going to go up like 5x. I'm like, okay, so when are you going to sell? And they're like, I'm not going to sell. I'm like, okay, so like, what makes you not want to sell this company? And they're like, well, I just think that it's always going to go up. And it's like, okay, yeah, but you look at the example of something like Tesla in 2021. Tesla is a great company, great business, but the valuation on Tesla was pretty insane. So it was around 400, maybe almost like, did it get to 500 in 2021? Do you remember that? No, right?
I'll pull it
I
up.
think, yeah, at the max, I think Tesla was almost at $450 a share in 2021. And there were a lot of people that were buying at the time saying, hey, this is the next big company. It's revolutionary. And, after 5 years, they're finally break even. So we're trying to hopefully help people prevent themselves from being in something that is so expensive that they have to sit on either zero gains for a long period of time, or they're basically get so jaded by the downward move that they could get out of the market completely. So hopefully, like I said, hopefully we can kind of show where some opportunities in the market are. There's also certain industries that people don't necessarily know how to value. And that's something that me and Steve can show you. Like, I'll give you a great example of something me and Steve have actually spoken to about for a long time. It's a company called Enterprise Partners. If you look over here, let me just share my screen. Me and Steve have been talking about this company for God knows, for pretty much ever, right? Enterprise Partners does not look like, oh my God, like this is just a pipeline company, but it owns one of the largest pipeline networks in the entire country. This business is literally a cash cow business, and at the same time generates a great yield. So right now, the dividend yield on it currently is 7.8%. So a lot of people say, well, it's only 7%. Like, who gives a crap about 7%? But then people forget, like, hey, depending on what your cost basis is, it could be actually a lot more, right? So if you think about this company, at one point during 2020, it was trading at $6 a share. Now it's trading at almost $16 a share. So you're looking at about a 3x, roughly, a little less than a 3x. But the entire time, Enterprise Partners was actually paying this really nice fat dividend that you could have just chilled on and done extremely well. So let me just show you. And the other thing is, even from right here, so 15 cents, and then they kept making more and more money, so they just up it, right? So imagine collecting all of these dividends the entire time, plus the capital appreciation. So that's what you kind of want to see for a lot of businesses that me and Steve actually look at, where these companies have great cash flows, but they also have a great business that supports really strong dividends. And it's something that, if you've done really well over the course of the last, 5 years, and you're like, you know what, I want to diversify away from just working 9 to 5 for the rest of my life. I actually want to have some income coming in. These are the companies that'll get you there. So
So we're going to probably do one or two names a week. And I think we're going to start with one that Kris and I have both owned. I believe we both own it right now. Full disclosure, I own it. Don't invest in it because I invest in it. But if you like the research, I would suggest doing more due diligence. Kris, you own it, correct?
I have options on it actually
So
because
you have exposure to it.
I
Okay.
have a lot of exposure to it. Yeah.
Okay. So we're talking about Verizon tonight.
Yeah.
Good old Verizon. And the reason why I like Verizon is because one, not many people do. It's a diamond in the rough for me. Getting paid about 6.7% or so to own it. And it's a new age utility company. And when push comes to shove, people are not getting rid of their cell phones. There are three main carriers. Verizon is a cash cow. And let me see, I'll bring that up. And when you look at the competition, it's only going to be T-Mobile and AT&T. You do not have to worry about another company coming in. It's a protected industry, and the capital to get into it is making it where the moat just keeps getting wider. And 21 years of dividend increases. So in an environment where the Fed is lowering rates, that is going to be very opportunistic for income investors because hiding out on the sidelines right now, I believe all bonds except for the 30 is below 4%. You're right now, the yield on cost is 6.7%. So even if Verizon increases in value, you're locking in the yield here and getting that annualized increase every year. And with more than 2 decades of a track record, it's very interesting. So where do you want to start, Kris? Financials, or where do you want to start
Yeah.
with it?
So I think we should just first start with the stock price because I think people need to understand why we're getting a value in the first place, right? So a lot of times what happens is when you pitch an idea to somebody and say, you know what, I think Verizon is a great stock to buy. They'll say, okay, well, like what's going on with it? And the first thing everyone does is they'll just go straight to the stock price, right? They'll just say, you know what, let me take a look at the chart on this thing because that's just how people look at things. So they'll just say, okay, let me look at the stock price on Verizon. And it's like, oh my God, it's $40 a share. In 2021, it was almost $60. Like, why would I want to buy this company? Like, it looks like clearly the stock has gone nowhere in the last 5 years and it's actually gone down. And so this is where you kind of have to first explain the thesis on what's going on with Verizon. Why is it the way it is? Why are you getting this great deal while other people are not getting this great deal, especially if they bought here at the top? What's the reasoning behind it? So let me mention a couple of things first. Verizon is not a growth company. This is a value company. So when you have a growth company, you're going to manage that company from an investment standpoint based on the growth of the top line. Verizon, unfortunately, it's tapped out in terms of its total growth going forward, where it could theoretically do double-digit growth if it really, really had a brand new market that it was capturing. But just the sheer size of these guys, it's really hard to do that. Like the law of big numbers applies to these guys like it's nobody's business. If you just look at the total revenues on this company, right? Let me just hide the stock price. You can see that right now it generates almost $137 billion in revenue per year. Let me repeat that. $137 billion. So if they were to grow at 10%, that means that they would have to find $13 billion of new revenue. Now, there are ways that this company could theoretically grow its top line by double digits. And we're probably going to see that next year. They just acquired another telecommunications company called Frontier. And so Frontier, if you just look at their revenue is about, let's see.
AWS strikes again.
It's down again?
I'm just kidding.
Oh, dude, don't scare me like that. I got work tonight, bro. I had to deal with this last night. Dude, don't do that to me. Okay, so they had about $6 billion in revenue, and Verizon just acquired these guys. So Verizon's top line will grow by 6 billion as they incorporate Frontier into it. But remember, whenever you're incorporating another business, it's not just plain, oh yeah, look, top line has grown by X percentage. You have to look at what the value that acquisition is going to do for Verizon. So Verizon, in terms of growing its top line revenue, it's not a grower. Okay. So if you see it's catering right now, it's catering at about 2% per year. So a lot of people will see this. And in today's market, they'll say, well, I don't really want to be in a company that's growing, barely growing. And this is where guys like me and Steve come in, and we start to dig down into the numbers, and we say to ourselves, like, what's going on here? Where is the value in this? And maybe Steve, you want to go to the next phase of explaining this thing to people.
So I'm going to remove yours and throw mine up. So I built this very simplistically so everybody could follow along. So there's a lot of companies out there that are getting a bid that do not generate revenue or just lose money. And while those companies could keep going up, there are companies like Verizon that are generating a ton of profitability up and down the line that are not getting a bid. And one of the reasons why people get scared about Verizon is this block right here. They have 124 billion in long-term debt on the balance sheet and 171 billion in net debt. Most people look at that. Now, the net debt is significantly more than long-term debt because of capital leases and other things. But when people see this, they automatically think that this is not sustainable. But what they seem to not see is that their gross profit is $81.5 billion. They have almost a 60% gross profit margin. And their EBITDA, which is all of their earnings before taxes, depreciation, amortization, is 36.5%, almost $50 billion. They have a net debt to EBITDA ratio of under 4, which is very healthy. They generate over 20 billion in free cash flow. And right now, they're paying 11.36 billion in dividends a year. After the dividend payments, they still have close to $9 billion in retained free cash flow. And when you go through the cash flow statement, this is very important. They issued 13.26 billion in total debt over the trailing 12 months, but they repaid almost 21 billion, and they've eliminated 7.4 billion between the debt that's been repaid and the debt that's been issued. So this is a company that is paying down debt, paying a nice big dividend, and has a ton of free cash coming in. And going through the Q2 numbers, we get Q3, I believe, next week. Revenue actually increased 5.2% year over year in Q2. You had EPS increase quite a bit. Their wireless revenue reached 20.9 billion, which was a 2.2% year over year increase. And Verizon added 300,000 net additions across mobility and broadband. And they added 293,000 net additions in their broadband segment. They were able to generate 12.8 billion in just 3 months in adjusted EBITDA, which is a quarterly record for them, and 5.2 billion in free cash flow. So they have the profitability to not just sustain the interest payments and the debt servicing, but to pay down the debt. So for me, this is a long-term value play because of the amount of profitability that they're generating. I don't see a world where Verizon is not going to be here. I don't see a reason why I'm going to switch my plan. And this is something that I think as interest rates come down and we look out on the yield curve, there's going to be a lot of income investors that are yield starved. And you have to remember something. There's over $7.5 trillion, or just around $7.5 trillion, sitting in money market funds on the sidelines. That does not include CDs or bonds. When that capital comes back in, where's it going? It's certainly not going to ACLA. So think about this. The people that are sitting in money market accounts, treasuries, or CDs, they're risk averse. They're not going in ACLA. They're not going in core weave. They're not going in these high flyers that haven't proven themselves yet. They're going to be trying to replicate the income they were generating on the sidelines. And Verizon is a name that they're going to feel comfortable with. It generates a huge dividend, and they'll be getting paid more than what they're making now on the sideline, and increases every year. So I think that we could see a broad market rally for companies like this in the future. And I think Verizon is trading at a valuation that just doesn't make sense because of a misunderstanding of the debt.
Okay, and let me stop you there. I think one of the things in the comment section, they're very right. They're saying, "Oh my God, look at that debt! There is so much debt." To them, I say, "Well, do you own a home? Do you have a mortgage? Why don't you just pay your mortgage off? Why don't you just take all the money that you have? You don't even invest in the stock market. Just pay your mortgage off." And a lot of people say, "Well, my mortgage is only 3%. I was able to refinance in 2020 and 2021." Do you know? Has anyone even bothered to look at Verizon's debt? Pull it up, Steve. This is the best part. And when people see this, they're like, huh? Wait a second. Like, how does this make any sense? So during 2020 and 2021, Verizon was able to take on a lot of debt. Let me just share the screen real quick. And they were able to do the same thing that you guys all did, which is take on mortgages for super cheap. Verizon did the same thing. If you look at the debt that they have some of these maturities right here, 2032, paying 2.2% in interest. In 2028, they've got this maturity 2%. They've got this one in 2042 that they're only paying 3.8% on, right? All of these things, this is super cheap debt that there's basically are generating on one side double-digit returns on the existing cash that they have versus on the other side, what they're actually paying to the bondholders is nothing, right? It's barely even keeping up with interest. So when you have that disconnect, people will say, oh my God, they have a lot of debt. But that's like saying to a person who has a mortgage, wow, you have a lot of you have a lot of debt on your home. Like, you're poor. It's like, no, look at the level of debt that they have, weigh it against the cash flows. Me right now, I can pay off my condo if I wanted to, but why would I? The mortgage that I have on my condo is at 2.75%. I would be a fool to take my cash that's generating right now in Verizon 7% return in just dividends, and then take that money, sell Verizon, and pay down my mortgage, and I'm only getting a 2% return, 2.75% savings on it. So you got to know when you're investing, it's not necessarily just about, hey, look at the total number that's on the balance sheet. You got to dig a little bit deeper into it. And a lot of companies that we're going to talk about, they have great balance sheets, but they also have businesses that utilize their capital in such an efficient way that they generate value for shareholders using leverage, right? So right now, Verizon, they were able to buy up a lot of spectrum, and they were able to buy up a lot of assets during 2020 that now is starting to pay them great returns. But at the same time, the cost for Verizon itself is not that high. So that's where we kind of have to stop with this whole like, oh my God, this company has a lot of debt. Because if you haven't done the research on what their debt looks like, what the cost of their debt looks like, what their business looks like, that's where I would start. So the first thing you have to say, okay, what is their profit margin? If their profit margin is 20% and their debt level, the interest that they pay is only 4% or 5%, that means they're making 15% with the money that they've basically borrowed at 5%, right? So a lot of times, a lot of companies, what they'll do is they'll borrow money. They'll borrow money at 5%, give it to the bondholders. They deserve their 5%, while the equity holders like myself and Steve, we're getting a 15% return on that same capital. So this is where I think the first thing that we have to do, and this is the lesson number one about this entire process that we're going to go over. we need to be a little bit more in depth with when we talk about companies and what kind of liabilities that they have. And a lot of times the market will ignore this part and they'll just look at this company and says, oh my God, they have a lot of debt on the balance sheet. And by the way, if you really think about it, net debt to EBITDA, which is what most companies, their financial health is measured by, these guys are only at 2.5 times. It's not like a super, super expensive. They're over levered. A lot of people, like some people I spoke to, they're like, man, they're gonna have to cut their dividend just to pay the debt. And I'm like, they pay $6 billion in interest charges right now. They generate 47 in EBITDA. Please tell me why they would have to stop the dividend just to pay debt. It doesn't make sense. So, yeah.
Yeah, I mean, with Verizon, most companies, so let me phrase it like this. The safest dividend is the one that just got increased. And Verizon has increased the dividend for 21 years. They just increased the dividend last quarter. The chances of them cutting the dividend are slim. Obviously, anything could happen. But when you have a 21-year track record and you are generating $49.9 billion in EBITDA and your free cash flow is over $20 billion, and you're only paying out $11.36 billion in dividends, to me, that's a good, healthy dividend ratio or a coverage ratio. So I'm not seeing in the numbers that the dividend is going to get cut. Now, as far as the debt, the good thing is they can choose to repay higher yielding debt. Since they have everything already amortized, they can decide where they apply their debt repayments to. And as the Fed cuts rates, they can borrow more debt and just pay off even more debt than they're taking out. So the balance sheet could end up looking healthier. And as time goes on, if they just increase their plans by 1% or 2% in a couple of years, nobody's probably going to leave. And that's just all credited right to the bottom line. So is Verizon going to 100? I don't think so. But when I look at the chart over the past 5 years, it's been sideways since 2024, since the beginning of it. I think it's formed a bottom. And for me, I'm still adding to my position in it. And once again, don't do anything that I'm doing. Do your own due diligence. But I like the fact that I'm getting almost a 7% yield in an environment where the Fed is cutting rates and that cash is getting plowed right back into Verizon buying more shares. And to me, this is a cash flow gem. You're paying less than 9 times earnings. I mean, think about that for a second. It's trading at $40.80 a share. They are expected to do $4.69 of EPS this year. Their price to earnings is less than 9. They are trading the way tobacco companies traded a couple of years ago. And ultimately, is this going to be a 20 PE stock? Probably not. But would anybody be surprised if this is a 12 or 13 PE stock? I don't think so. So I think that there's some upside in this with a very big dividend that can continue to get bigger. So I think it's an interesting name. I think it's a misunderstood opportunity because I think people look at the debt load without actually tearing through the cash flow statement. Kris, you're muted.
Yeah. When it comes to a business like this, when markets are absolutely insane in terms of valuation, there are going to be times where the market is going to get a little bit jittery, right? They're going to say, wait a second, like, what the hell am I, buying right now? And if, let's say, the market does have that moment of correction, you're going to see a lot of people pile into names like Verizon, which are a lot safer, right? So when it comes to, let's say, a recession, and we always get these every 4 to 5 years, whenever you get these periods of market volatility and correction, people, they shy away from the high beta growth names. They start going into low beta. And so right now, with interest rates that are coming down and they're being cut, there's a lot of people right now, they're pretty comfortable making 5%, 6%. Like a lot of endowments, you know, they can live on 5, 6, 7% in interest. But now that the Fed is cutting, a lot of them are going to be yield starved, like Steve was saying, and they're going to be buying up things like Verizon. The other thing is because of the safety nature in Verizon's business, where their revenues don't shrink. That's the other thing. Like they don't go down by 15, 20, 30%, nor do their valuations crazy right now. So you don't see like 50 to 60% retracements in the stock price. People will gravitate more towards Verizon and companies like this. So one of the things that me and Steve we've seen over a long period of time is when there's excess speculation in the market, you have to have enough courage to not be in the speculator camp. You actually have to be in the other camp and just, and you have to bide your time. And I hate to say this, but sometimes you'll see like other companies riding 15, 20, 30% in like a month. And you're like, man, what am I doing? Why am I sitting on this company that's basically barely growing? And that's when you just have to know that, hey, wait a second. Like, no, I've done extremely well in my portfolio over the last 5 years. My portfolio is stacked. My goal now is wealth preservation, but then also to have a great return going forward. So I think right now it's for the last 4.5, 5 years. It's been I would say 4 years. It's been a growth investors market. But I think over time, we're going to be eventually going into a more value centric approach to investing. I do have options on Verizon. And the reason why I have options as opposed to plain stock is that while people are going to be chasing the dividends, I'm actually chasing the options returns. Because if you guys know anything about options, the way that options pricing works is it's actually done based on volatility, not necessarily fundamentals of a company or the stock itself. So a lot of people, they'll say, well, I'm looking at Verizon and, like the options don't really make sense because you're saying, Kris, this company can't go up by more than like 15, 20%. But the thing is, because there's not a lot of volatility, what tends to happen is options are actually extra cheap. And so if you know and you have the right strategy, you can buy the options on Verizon very cheap. And then as the market finally starts to figure things out and the stock goes higher, your options, they do really well. So, yeah.
Yeah, and I'm gonna step in and say don't just buy options because Kris is talking about it. Kris has a lot of years of experience with this. So please do a lot of due diligence and do not just turn options on just because you heard somebody talk about it.
Yeah. I would say understand how the options markets works before you go into anything. But let's talk about real quick there the current what is it called? The analyst targets for this thing. So currently the analyst targets are about it's about $50, I think, on average, about 49, 48, 47, 56, 50. So for the most part, this is a very predictable business. And you can see here that their EPS growth is not exactly that great into the 2029s. But one of the things that you're going to see is with some acquisitions that they have and some value accretion, they're probably going to grow their EPS quite substantially over the next couple of years. So they're probably going to go from about $4 a share to about 484 in 2025. They're estimated to do about 485, and then the year after that they're going to do 5. So if you think about it, a company like this, people give it between 10 and 12 on the valuation scale. So this could be between $50 and $60, right? So if let's say on the low end you give it a 10 PE in 2026, that is going to be $50 a share. If you give it a little bit higher and you think that, they're going to be able to reaccelerate their growth, they're going to be able to pay down their debt faster with interest rates being cut, then of course this thing could get re-rated to maybe 12 PE, and that way the stock will be like 60, right? So at the current $40 stock right now, if it goes to 60, you're making a 50% return plus whatever the dividends that you collect along the way. So
yeah, and the other thing with Verizon is when I look at how it's trading to its free cash flow, it's trading at 8.55 times free cash flow. You can't find many businesses let alone a business that generates the amount of revenue and profitability that Verizon does for less than 15 times free cash flow. And the fact that they're trading at under 10 times makes me think that there is an opportunity here, that there is a mispricing of the underlying equity. And with the momentum that I've seen in the Q2 numbers, I think that's going to continue in Q3. I'm very excited for earnings next week because this is trading at a valuation that just makes sense to me.
Some really good questions on here. So one of the first questions that I see is that actually is interesting. Let's see. So Matt asked, curious how EPS can grow if they pay down 30 to 35 billion in debt between now and 2030. I think, Matt, you just answered the question yourself, right? Because EPS is based on what? Earnings per share, right? If they pay down 30 to 35 billion dollars in debt, that's less interest charges that they have to pay. If they pay less in interest, where does that money go? That goes back into the earnings, right? So if you think about it, the cost of capital, whatever the cost of capital is, they pay down the debt. That's less interest they have to pay going forward, which means that money drops to the bottom line. So not to mention, if they have certain debt right now that's yielding 7-8% that they had to issue over the last couple of years, if they can refinance that down to 5% with interest rates coming from the Fed, that's a 300 basis point savings on that debt. So they're able to kind of lower that down. So if you think about, let's say 10 billion of the debt is issued at 8%, if you're able to lower that down from 8% to 5%, that's 300 basis points reduction that you're going to have to do. So that's literally, it goes from at $10 billion, that's going from per year, you would be paying 800 million to 500 million. So that means that you generate $300 million of additional profitability off of just interest rates going down. You didn't even do anything to the business. So that's the one thing people really will probably understand as interest rates start to come down, where companies like Verizon, it'll be easier for them to issue new debt at even cheaper prices. So Verizon has different layers of debt. So they have debt that they issued in 2020 that was like 1, 2, 3, 4%. And then they have debt that they issued a couple of years back that's more like 7, 8, 6, right? That they're going to be able to kind of pay down and then get the debt servicing costs lower. So one of the things is, if you look at Verizon's debt, as they recycle their debt levels, their interest charges have been going higher. So if you look at their interest expense, let me just minimize this thing right here. And right here. So before, in 2010, they were paying about 2.5 billion in debt per year. And you can see here that they took on a lot of debt during 2020 and 2021. And then they had to refinance some of that debt at higher interest charges. So literally it went from 3.6 now to 6.5 billion. So that means they're paying an additional 3.5 billion in debt that they were not paying in 2021. Well, one of the reasons why is because of the higher interest rates that they have to do for the new debt that they have post acquisition. The good thing is, over time, that debt is now stabilized, right? So you can see this nice cascade going down, but now you see this thing happen where the debt is actually going the other direction, where it's actually stabilized. And as interest rates get cut, this starts to move in this direction. So number one, this goes down because the new debt that they issue, because the Fed is going to be cutting,
And Chris,
is going to help it
I'm
go
going
this
to
way.
stop you for one sec. I think it's important when you have this up to explain why the debt got so much more over the past couple of years. And it's because of the spectrum sale.
Yeah. So one of the things is in telecommunications, especially wireless telecommunications, companies have to regularly purchase real estate, but the real estate isn't necessarily like physical on the ground. It's in the air. There's a certain spectrum that's out there that is the next generation. So whenever you go from these different generations of communications, like quote unquote the bands, you have to pay licensing to the government to basically say, hey, listen, we have exclusive rights to send out a signal in this bandwidth. Okay. So think of that as real estate. So Verizon had to go out there again to T-Mobile and AT&T and all these other guys and say, hey, listen, we are willing to pay X amount of money for this exclusive right to basically broadcast a signal in order for us to do our business, and we are willing to pay X amount of money. So Verizon paid almost $40 billion to get a whole bunch of spectrum. Now, the thing is, you would ask yourself, well, why does Verizon need all this additional spectrum? Well, the thing is, think about how many more devices exist now than ever before. You know, if you go back into 2020, how many people had cell phones? Right now, everyone has a cell phone. How many people right now how many cars right now have their own mobility in them now, like internet in them? Pretty much almost every car, right? You have all of this next generation of autonomous driving and robots and like trucks that need internet connections to basically have like IoT monitoring, everything. All of those things require some level of connectivity. And Verizon understood that. So they were willing to pay that money up front, bought all that spectrum. So they have a lot of real estate. If you look at ASTS right now, all the ASTS bulls are like, oh my God, ASTS, the greatest company on the planet. It's going to generate tons of money. Without that spectrum, ASTS is garbage. Okay. But luckily, ASTS and Verizon have a partnership. So everyone who's going to have a mobile phone and they're going to have that connectivity to the satellites via ASTS and everything else in those dead zones and everything else, Verizon's going to be making money. ASTS is going to be making money. See that happy partnership? Verizon could not have partnered with ASTS if they didn't have that additional spectrum. And ASTS would have been shit out of luck without Verizon having that spectrum. So it's a symbiotic relationship that they have with each other. So a lot of time you have to really shell out this high amount of capital, but the revenue that you're going to get is going to be insane over the next decade, if not for the next 20, 30, 40, 50 years. So Verizon luckily had the money to pay for it. And what's great is that because they have the money to pay for it, even while they're using debt, that means that no one else can say, you know what, we're going to start sending out a signal using that same frequency because it's all owned by Verizon. So that gives it a huge moat compared to other businesses. So it's not just like, hey, listen, I can set up my own phone service. You know, no, you can't do that. You have to have the spectrum, you have to have a license, and you have to send out the signal. And that's what gives you that nice exclusivity. So it gives you this nice giant moat that Verizon has right now. Sorry.
No, letting you go. I mean, everything's spot on. Verizon did acquire the most spectrum in the sale, and the sale is through the US government. It's not some company that owns the spectrum. And that's another reason why there will probably only be 3 big telecom companies. It's why T-Mobile and Sprint merged, so they have a better chance of competing. So it's an industry just like utilities that's protected in a way, and you don't necessarily have to worry about other companies coming in. And I don't think that while this could happen, I don't think SpaceX is going to be allowed to compete. I think it's going to be a secondary type provider with Starlink.
Yeah, and
Now,
there's a lot of room for expansion potential
yes.
here. You know, you're looking at the number of, like right now, if you think about it, so some people in the comment section, they're saying, why would you buy a company like Verizon during the AI boom? And I say to that, well, think of everything that everyone is talking about, how AI is going to revolutionize things like robotics. Do you think the robots are going to run on magic? No, they're going to need an active connection. You see these robots running around in the middle of the street doing deliveries right now. What do you think? How do you think they connect to the internet? They connect through a Verizon wireless, what is that? They call modem,
Yeah,
right?
think about it like this. You go buy an iPad, you can either run it off of Wi-Fi or run it off of cellular. The difference is when you take your iPad places, you're probably always going to have Wi-Fi or be able to hook up to Wi-Fi. With robotics, if they're out doing stuff, they need a dedicated proprietary cellular connection. They're not going to be stationary in a house. So there is likely going to be a very big boom with cellular connections with robotics, which is definitely going to be a growth catalyst.
Yeah. Same thing with over-the-air updates. You think right now you have a Tesla. Where do you think you're getting your over-the-air updates from? You know, and a lot of people say, well, it's coming from the satellite. I'm like, okay, so tell me, if you're parked under what is that thing called, a parking lot, how are you getting your update? You know, not satellites don't cover everything. Not to mention, you actually need still some sort of receiver in order to get it. So I think people are underestimating the value that the 5G build out has basically been invested, and over time now, these businesses are going to be capturing value long term. So there's a lot of business segments that Verizon and T-Mobile and even AT&T they didn't even exist 5 years ago that are completely new that they're stealing market share from. So as an example, you look at what is that thing on cable? You know, if you go 5, 6 years ago, I think cable at one point had almost 80% market share in broadband internet. And over time, they're losing that. Why? Because now you've got something called fixed wireless, where you can just literally get a box that connects to your local 5G signal, and you've got internet. You know, so that then you have FiOS, fiber optic, super low latency, high bandwidth. People are moving over to that. They're like, I don't need a cable plan. I have FiOS. Well, where's that FiOS? Well, that connectivity coming from? It's coming from Verizon. Same thing with T-Mobile and AT&T. So, even though these guys are competing against each other, there is value that each one of these companies has, and they have a lot of entrenched businesses that have a bunch of catalysts that are coming that are going to be coming forward. So on top of just, hey, is this a dying business? No. So when someone says to me, hey, I like Comcast because it's a value play, it's trading at, I think, 7 times forward PE, I say to them, not really, because they're probably losing market share to these telephone companies right now. And so that's a debate between technologies. So I think that companies like Verizon, they have the ability to generate real shareholder value and in a safe way. And, as long as you know what you're doing, it's a great business.
And keep in mind, Verizon's not the most exciting company. I don't know anybody that's investing in it to try to replicate or beat the market over the next 5 or 10 years. But for now, it is an undervalued gem. It could catch a bid if there's a cycle in the market. And at the very least, it is a strong income producing asset. And a lot of people seem to forget, because I think a lot of people that follow us tend to be younger and tend to look at things like Nvidia and Amazon, as we talk about that a lot. And it's just always in the news. They're consistently going up. And why go into something like Verizon? There's a whole segment of investors that are geared toward income because they're later in life, or they just like the idea of having supplemental income coming in. So Verizon is one of those companies that can provide that supplemental income with potential for capital appreciation because it is so undervalued. And not every company is going to be a 5 or a 10x. Verizon, I wish it was. I don't think it will. But at the same time, it can provide a layer of security to a portfolio that has a lot of growth in it because it has consistent income coming in every 3 months.
Yeah. It's funny. A lot of like my father-in-law, he's retired, right? He's got a good amount of money. For him, one other thing is, even the dividends that Verizon pays, they're qualified dividends. There is a huge benefit to having dividends that are getting paid to you as a qualified dividend. So let me just show people. Can you explain qualified dividends to everyone?
Qualified and not qualified is, look, I'm not an accountant. I think everybody should go on the IRS website or ask your CPA. But qualified dividends, you pay, I believe, a lower tax rate on them.
Yeah. So one of the things about qualified dividends versus something like ordinary income. So if you buy a regular bond, the interest that gets paid out as ordinary income. There's REITs out there that get paid to you as ordinary income. But when you have a corporation like Verizon, they have something called qualified dividends. And if you can share my screen real quick,
Yep.
Steve, depending on where you are personally in terms of your taxes, right? You can actually pay almost nothing in taxes. Right now, you look at this, like my father-in-law, let's say he has $1 million, he puts $1 million in Verizon, right? Buys it at $40. He's getting almost 7% interest per year. So he's making 70 grand that year. Do you know how much he pays in taxes on that 70,000? Zero. Up to $96,000 if you're married filing jointly, you're getting 0% in taxes. Okay? Tell me this is not freaking amazing. So for a lot of people, especially older people, companies like Verizon is where they're going to park their money. Okay. He could sell his house right now. It's something about $600,000. He sell that $600,000 house, put it into something like Verizon, and now he's generating a great return. He's not really having to pay much in taxes for it. You know, so between his Social Security and this, he's good. He's golden. You know, and let's say any money that's after that $96,000 up to $600,000, he only has to pay 15% on that money. Okay. So from a tax efficiency standpoint, this is also another great thing that you want to be in. So like I said, a lot of people will look at this and say, you're telling me I'm getting a 7% qualified dividend where I don't have to pay taxes on it. Pretty good return. So right now, everyone is kind of chilling right now with their what is it called? With their treasuries. But eventually when the 10-year is down to 3% and putting it in money market, you're barely making any money. People are going to say, wait a second, I need to put my money somewhere. And you know where they're going to go? They're going to go to Verizon. And what's going to happen is as people go into Verizon, they're going to bid up the stock price because the yield is based on the stock price, which your entry price. So right now, if you buy at 40, you're getting a 7% dividend. Okay. But if you buy it at 50, you're only getting a, what is it like? I think like a 5.5. No, it's actually around 6. I think 6, maybe 6-ish, 6% dividend. Right. So that's how it works out. So a lot of people, they're not going to be chasing yield right now, but as interest rates come down and there's money sitting in money market, all that money is going to come into this. And by the way, next year, the dividend tax rate almost goes to 98,000, you know? So yeah. So learn about your taxes. That's one of the things about investing. I hope people do that too. Like they understand where they are in their life, where they are in terms of their taxes, and this way they're not sitting on a whole bunch of things and they're having to pay taxes on it for no reason. So
Yeah, and look, there's obviously different strategies on how to generate income. You can absolutely purchase blocks of 100 of XYZ. I shouldn't use XYZ because that's an actual company. DCB companies, I don't believe that's an actual ticker, and sell cover calls on it. But at the same time, not everybody wants to do that. Verizon is a steady pair with growth, set it and forget it. And the numbers look very interesting. And one of the other things is they're not buying back shares yet. Now, when you have $8.76 billion in retained free cash flow after the dividends, you're in a position where you can take that money, throw $6 billion on the debt repayment, and then take 2.7 and start buying back shares. So I am betting, or I'm going to predict that over the next 3 years, we're going to see a buyback program get implemented. And that also will help the EPS grow over time and could help Verizon rise in value from its share price. So I think there's a lot of interesting things. And look, when I do my research, the numbers look very compelling to me based on their profitability.
yeah. Yeah. For me, I see different growth vectors that they have, but I'm inclined to agree with you as well, where I think structurally this is a very strong business. It's been around for forever. generates great returns. But I think the thing that I'm drawn to about this is that the safety aspect, right? So when the market valuations are just absolutely insane, I tend to focus on things that are more value based. Now, yes, will I underperform versus buying the next hot new thing? Yeah, but a segment of my portfolio is geared toward just safety. I'm not the young 20 year old that's making, a few like $100,000 a year. I'm sitting on a lot of capital, and like I said, my goal now in life is to make sure I'm preserving that capital. And that's the thing. As you get wealthier, you're gonna realize like you don't want to be in a position where you're like, yeah, I'm sitting on a beach somewhere with like multi 7-figure portfolio, and then you look at your portfolio and you're like, holy shit, my stock is down 40%, 50% from where I bought it, and now your net worth goes down by 7 figures. There's this one clip. Maybe we should watch it. I hope we don't get demonetized. We probably won't get
Don't
demonetized.
play it. We're not playing
No,
it.
it's from The Gambler. It's we're not gonna get demonetized. Hold on.
No.
You know which one I'm talking about?
I know which one you're talking about. We're not playing it.
All right. Well, whatever. But everyone who's
Get up
watched The
2
Gambler, great
million,
thing.
buy a house, freaking 30-year roof. Yeah, I think everybody knows the quote.
Yeah. And that's the thing. So get to the point where you never have to worry about working ever again. And then you could be all risk. You could take on all the risk you want, But that's the thing. Like if 60% of my portfolio, Steve, is in fixed income. 60%. I only speculate with 40. Well, not speculate, but I invest the other 40. But 60% of it, I don't worry about it. It just generates return and keeps compounding on itself. What about you? Like what percent of your portfolio is in just income producing things?
I have no idea. I have to look. I don't have everything on a single spreadsheet. I have multiple accounts. It's a good amount. I mean, keep in mind, I am a firm believer. Once again, this is different for everybody for a number of reasons of what I'm going to say right now. But if you work at a company, you are not likely to be able to control your own investments on your 401. So, because I don't have the ability to invest in individual equities through my retirement accounts, I have 100% of my retirement in a S&P index fund. So that's throwing off 1.3, 1.4% right there. And, that also helps diversify a lot. So I'd have to really look at it because I'd have to consider that part of an income producing asset also. I'm not really sure, but look, the best definition I've ever heard of what rich is from Scott Galloway. And he said, when your passive income exceeds your liabilities, or what your better word for liabilities would be, your passive income exceeds what you are spending per month to live.
Yeah.
I think that's the best definition of rich. I really do. And a lot of people look at the market and they're only invested, or they're only looking at one area. But what happens if we get that 10 or 15% correction? A lot of these high flyers are likely to get a much bigger hit. Now, I'm not saying that that's going to happen. There's no data that makes me think we're going to enter into a recession in the next quarter or two, but there is data that makes me believe we could, in the back half of 2026, have some problems. Retracements are healthy. They always happen. And while the market always rebounds, during periods of volatility, the high flyers always do worse. Keep in mind, 2021, even Apple, which was holding up the market for a very long time, took a 40% haircut. Amazon and Alphabet were both down more than 50%. So if something happens outside of what the current landscape is telling us, having fixed income or having income producing assets could help in a barbell approach de-risk a portfolio or mitigate risk.
So a couple of things. Someone said, Steve and Kris, I have a question. Do you guys have income producing assets in separate brokerages? I do. Most of my income producing, not most, pretty much everything is in Fidelity. Why? Because Fidelity has a much larger breadth of investments than Robinhood does. Like, there's a lot of things that I buy corporate bonds. Robinhood doesn't do that. You basically just have equities and options. Robinhood does equities and options very well, but in terms of fixed income, Fidelity is better. I've heard IBKR is okay too, but I have a guy at Fidelity. I literally just call the bond desk and, hey, listen, I see there's the new issuance. Get me into it. I have some muni bonds as well. Like I said, my portfolio is stacked with just different fixed income stuff. Like I have preferred equities with Brookfield Property Partners. That's yielding a really good return, and then
You still have those?
capital appreciation. Yeah. I know you at one point you got me into SL Green, did really well on that. I don't have SL Green anymore though, but I do have Vornado preferreds that are yielding almost things like 7-8% now. So yeah. Like I said, I'm at a point in life where it's more prudent for me to preserve my wealth. And there will be times where if the market dumps hard enough, I will get out of fixed income and go 80-90% in equities. All right. But the thing is, you need that firepower during that time where you can deploy a lot of capital very quickly. And if you got one of the greatest investors on the planet, Warren Buffett, sitting on all that cash, he sees some value coming. So I don't know. Maybe people think that the Oracle of Omaha is an idiot over the last like 3 years because he missed out on Nvidia. But I'll tell you right now, no one gets to his age making the returns that he's got to without some sage-like patience. So,
and it's a lot easier to be patient when you have income rolling in.
Mm-hmm. Yeah. Verizon also got cut in half. Divvy stocks also get hit when they aren't immune. So, and that's the thing. And I'm glad, Jake Rizzo, you mentioned that yes, Verizon did go from $60 to $30. But one of the reasons why you got that great deal is because interest rates got raised very quickly to combat inflation. Now that we're on the other end of that and interest rates are coming down, what do you think happens? It's a clear mean reversion story. The difference is when Verizon was trading at $60 5 years ago, they didn't have the same earnings that they do now. They have more earnings. They have bigger dividends now. So just goes to show you that I don't think we'll get back to the ZERP era ever again, but there's still a lot of value in this thing going forward. So, yeah.
Yeah, I mean, look, Verizon's not for everybody. Who knows what's going to happen? All I know is that it pays a very large dividend. The Fed is cutting rates. We could be in a position where they could borrow more debt to pay off higher yielding debt and actually have an accretive spread. And the free cash flow is huge. The free cash flow looks like it's growing. They have retained free cash flow. They could start a buyback program. And look, it's not an exciting name, but it is a name that people will not think twice about owning because it's Verizon. There's stability. They trust it. And where is the money going when it comes off the sidelines? I'm not convinced it's going into tech because if it did, it would have already gone in. And look, when you make a big score, a lot of people in the chat are probably sitting on really big scores. Nobody ever got hurt taking a profit. And when you take a profit, sometimes it's not a horrible idea to roll money into income producing assets, a small portion of that, and start building it a little by a little. And over time, that stream of income, when you set it and forget, you just let it reinvest and compound, it can grow into something really big.
Yeah. Yes, sir.
Yes, if you sell cover calls on Verizon, you still collect the dividend as long as your shares have not been called away. So
the one thing I'll say about anyone trying to sell calls on Verizon, I mean, you'll make money. It's just not going to be a lot because it's a very low beta stock. So even if you sold a covered call, the premium that you're going to get is so trash that I don't even know if it's really worth it. The companies that you want to be an option seller on are things like BNMR. They have huge IV, so you get this huge premium, right? With Verizon, there's no, I want to say there isn't any premium, but the premium is very small, so just keep that in mind. So option selling on things like Verizon, you know, I don't know.
I mean, look, when it comes to that strategy, maybe you pick up a couple of percent. It's
Yeah.
not going to be the way that you can do with these other things. There isn't the implied volatility.
Yeah.
Yes, I don't like Chevron. I happen to love Chevron because the numbers are so freaking appealing. And I think that everybody is discounting the Hess deal and what that's going to transform this company into. That is a company that I'm going to pitch to Kris that we do on this show.
Yeah. Yep. We'll figure it out. I think when it comes to low beta names, you have to know what you're doing with the options side, right? And I don't want to. All right, distract everyone for a few seconds, Steve, while I bring up something real quick.
Yeah, sure. You know, Amit, I have a question for you. Did you have your second steak yet? But look, this is a question that people have to answer for themselves, and it really depends on what you're looking for. There's a lot of good companies out there that pay a quality dividend. There's also, if you want a big dividend, there's also some good ETFs and closed-end funds that pay a very lucrative dividend. There's actually one, and shame on me for not knowing about this company sooner. I just invested in them. I did not buy a lot. The money in your pocket will buy what I bought in it. I bought it for my dividend harvesting series on Seeking Alpha. Picked up a couple of shares because I put $100 a week in that account and document all the buys. It's only income producing things. The ticker's ADX, the Adams Premium Equity, I believe, closed-end fund. This fund's been around since 1929. I can't believe it. And it has huge portfolio of tech and other great assets, pays a distribution yield of around 8%. But look, there's funds like QQQI that I really like, or even DIVO, DIVO, or the BlackRock Science and Technology, which is a closed-end fund that has a big allocation toward tech, and it pays an 8%. But if you want individual stocks, I mean, I don't know. I like Verizon a lot. I like Altria Group. I like Energy Transfer and Enbridge. Now, keep in mind, when you're going down the MLP road, you have to remember that they issue a K1. There's a whole different tax schedule with it. So please talk to an accountant and do your own due diligence. But I do think energy is going to come around because with the data center build out, we need more energy. We don't have enough of it. We need more natural gas. We need more transition lines. And these are businesses, Kris, I'll bring it up in one sec. These are businesses where, similar to Verizon, Kris and I cannot go call a bunch of people, raise a bunch of capital, and decide we're going to start a pipeline company. We can't go buy the land and then go apply for the permits and get everything done to actually build the pipelines and start transporting natural gas. Can't do it. You can go create a tech startup tomorrow with capital. Energy infrastructure, you can't. So the moat around energy infrastructure is so big. I think that there's going to be a renaissance in it in the future. I just wrote an article on Enbridge. If you read it, you'll see my entire thesis on it. But I think there's opportunities there too. And look, Enbridge is paying 5.5%. So there's interesting plays out there. Amit, I'll text it to you what I think.
Yeah.
Milkman pipelines. I love that. Transporting milk daily. Love it.
All right. So I just took a quick snapshot from a position that I had last year when you called me, Steve, when you said, let's take a look at Verizon. So I said, okay, let's take a quick look. And I said, wait a second, this makes no sense. Like in terms of beta, this is super low beta, but it's super undervalued at the time. So I was able to get into an options position on this, and I made 129,000 on this position and 79 on this one. Of course, I had a spread position, so my other side was, as it went up, it basically helped subsidize my other side, but it didn't create like a huge loss or anything. So I was able to make almost 100K on this one thing. And so people say, well, how long did you have to hold it for? And the thing is, if you know how to do low beta and know how to mess with it, you can see here, I bought a lot of these positions in December and sold in March.
So I'm actually linking in the chat Chris's X account. He puts out great content every day. If you're interested, go follow Kris. He puts out great content.
Look at that. You tell me, is this a good play or not? People will be like, oh my God, how do you do that? No, just if you know how you're doing options and how to manipulate the market to your advantage, you can do very well with this. So good times. By the way, if you ever with options, you have date sold and you have date acquired, just got to know how to do that. But yeah, there's a lot of mispricing when it comes to low beta names. So whenever you're looking at options, it's not necessarily the greatest idea to be in an option seller with low beta names. But when the market is absolutely stupid, you can make a lot of money. So,
yeah, I mean, that's one of the things for me, at least. I have investments across the board. I'm in heavy NVIDIA, heavy Meta. I'm also heavy in a lot of other things, some of the things income producing assets. I just got out of SL Green. I was heavy in that for quite some time. And look, when I pitched Kris in the mid on SL Green, it wasn't easy to go into those names. But I showed them the data. Then Kris went and looked at the debt profile, and we did pretty freaking well on it. I mean, there is ways to do well in areas that people aren't looking at. And look, I think the S&P is going to finish at 7,000 this year. I've been saying it since the beginning of the year, but that doesn't mean that we're not going to have a broad market rally. And let's think about robotics and AI. At some point, these companies are going to become more efficient. And Kris, have you looked at Verizon's employees recently?
No.
So I think you're going to find this interesting. So Seeking Alpha actually tracks their total employees.
Mm-hmm.
I was flabbergasted when I saw this.
They're all declining? The declining number of employees? Yeah.
177.7 thousand in 2015.
Yeah.
And now they're just under 100,000.
Oh, be careful, man. That's some headcount reduction measures that they probably did. Nah, it just means that they probably shifted a lot of that headcount to India and to the Philippines. That's why every time you call Verizon, it's like, hello, how can I help you, sir? That's because our cousins aren't getting paid, man.
You have to think that they're going to have more expansion in their margins due to robotics and due to AI.
Nah, man, I agree. But I'm just saying, right now you call Verizon, you're going to get Amit's cousin, That's probably one of the reasons. So your total number of employees is going down, but they probably went from hiring U.S. Employees that are based here to basically doing. I mean, I've seen this happen to a lot of businesses, Steve, where they'll say, "Oh, the total number of employees is declining," but then the reason why is because they just signed these long-term contracts with these what are they called? With service providers, That's why I stopped looking at the headcount thing after 2021. You remember when Meta and all of these guys were just hiring, headcount was just insane. And then all of a sudden they were able to let people go, but the services stayed the same. So I stopped using headcount as a measure of success, both up and down, in terms of efficiency. So, just like I said, I know that that's a thesis for you, but to me, when I look at it, I say that it's almost like Amazon. Like if you look at the headcount on Amazon, right? If you go to
Amazon's
any,
my dark horse right now.
huh? Say again?
Amazon's my dark horse right now.
Yeah, but here's an example. Amazon, one of the things that they do is like, like all their delivery drivers. So all these people are like, oh my God, Amazon, it hires all these people hired. And it's like, no, Amazon hires the company that basically hires all these people to do the delivery. So they don't ever have to basically consider them Amazon employees and pay them benefits and everything else. So it's almost like these fulfillment companies. They're like, fast service LLC. And the thing is, they'll lease a truck from Amazon and they'll have like the Amazon branded logos and everything. But basically, they're getting paid by Amazon. So I think headcount used to be a good measure of profitability and everything, but I think it's being distorted right now depending on the business. So, yeah.
Yeah, we'll see. I mean, I'm so excited for Amazon earnings. Well, maybe not after today, but I was excited for them.
Yeah. Yeah, I think Amazon is definitely one of those companies that you have to. Amazon's getting hit by two different things right now. Number one, their AWS market share is starting to kind of go down. It's not that the pie isn't growing. It's just Amazon's share in that pie is not growing nearly as much. And then, and by the way, I know some people in the chat, they're like, oh, they're just outsourcing everyone. They're not always just outsourcing. It just means that they might be doing something that prevents them from having to declare people as their employees. So even like here in the US, I've seen this happen where certain big companies, instead of taking on employees that are employed by the company, what they'll do is they'll subcontract. And the thing is, the subcontract does not increase the headcount. Why? Because when you're starting to do layoffs or whatever, you can just cut the subcontractor. And now you don't have to do like this massive layoff. You don't have to do all these crazy benefits. It's just how the business is. But Verizon 100% has been doing a lot more outsourcing. So not a big fan of that, but whatever.
I'd rather the jobs be here.
Me too. I agree.
100%.
And I think I've spoken to people who have much better candor and service here. Not to say that like the agents that I've spoken to in the Philippines or India have been bad or anything. It's just I would prefer if they were here, And I think the one thing that the Trump administration is doing that is good is that they are starting to kind of like talk about this more. So Kris, BMNR versus Verizon next 5 years. Go away, Amit. Go away. See, I'm telling you, Amit's like the degenerate. Like, what's the next play, guys? How are we gonna become multi-millionaire? Shut up, Amit. You already made money, bro. Put your money away, some fixed income. Spend some time, find a wife. Make Mama Papa G proud. I'm sure your mom and dad are probably like, Amit, what's going on, beta? You don't like girls? You like boys? You want to look at boys?
No, he needs to keep grinding is what he needs to do.
Grinding.
He's young.
Oh man, I'll tell you a funny story. One of my cousins, this dude was like 36, and in Indian culture, they're always like parents are always trying to get you to basically marry somebody, right? And one of the things that they do is they have something called a bio data, and I'm sure everyone in the Indian, like that's Indian in the chat, they'll confirm. So basically a bio data is exactly how it sounds. It sounds like a CIA file on this prospective other person, right? And I had that. My dad laid it on me. He gave me like a thick booklet, and there was like I think like 20 girls on there with like pictures and like what they did and like what school they went to, what kind of education that they had. And he was like, okay, go ahead, pick one. And I'm like, I looked at him. I was like, bro, this is not gonna work for me. I'm not the guy, right? But one of my cousins, they showed it to him, and he's like, it's like turning into like he's almost 40 now. And so his dad was like, man, I've shown him like 100 bio datas, and this guy keeps rejecting everyone. What do I do? And bro, my dad being the clown that he is, he's like, have you shown him any bio datas for guys? Because he's probably closeted. I don't think he's closeted. He's just a very big introvert. But the point is, That's what happens in Indian culture. You know, you get these CIA profiles on people, and you got to make decisions. Yeah, they come with dowries. Nah, I didn't see that section. I wasn't paying attention to that. I'm sure if I asked, I could have actually got a nice dowry, but yeah.
Wow. Fritz Walter, are you hacking my Seeking Alpha? What do you guys think of Misty as an income play?
Ha! I'm against that. I am
have an
anti.
article coming out about Misty tomorrow.
I hope all you Misty people all lose your money. All right. You Misty people are the worst degenerates in this damn market. I still remember when you guys were pumping Misty like, guys, don't worry. The dividends will pay for themselves. They're going to pay double the stock price. Don't worry, the return. And I'm just looking at you guys. I'm like, wait a second. Like, this makes no sense. They're basically giving you your own money back and calling it yield. You know, so what do you think now, Steve? Was Kris right?
I think I sucked 22.48% of my initial investment out, and it's going to take me between another 24 to 47 weeks to get the rest of my money out. And then I'll have a free asset on my hands, is what I think.
Jesus, man. I'm telling you, all these people, they were pumping Misty, and I'm like, Steve, you can't be serious, man. Like, this doesn't make sense.
You know what's crazy? So I bought Misty and I bought NVDY. NVDY, I think, I can pull up my spreadsheet. I think it's paid me back 19% of my initial investment. And it's also up 3% on the underlying equity.
That's because the NVIDIA has gone up. But the thing is, had you just bought NVIDIA, you would have done better.
I did just buy NVIDIA also. A lot of it.
But that's what I'm saying. You should have just took the entire balance, put in between the amount of money that you have to pay on taxes on these stupid dividends.
No, no.
It's like Bernie Madoff, bro. All he's doing is paying you your own money back and calling it a dividend. Like, it's not even. Oh God, all these yield max products. I still know that there's like a bunch of people that are just like,
wait till yield max makes a BMNR one.
Oh God, please no. Please no. Please no. Please.
Oh, it's so funny. So funny. We'll see. I mean, I bought them as an experiment to see if I would actually get my liquidity out of it or not. We'll see what happens.
It's like not legit. It worked if MSTR was up, but MSTR has been trashed because that's the whole point. That's what I'm trying to say. The thing is, Bernie Madoff can support his Ponzi scheme as long as the stocks keep going higher. But the thing is, the minute that the stocks don't go higher, the Ponzi scheme does not work anymore. That's the problem, guys, with Misty and all of these yield max products.
Did you see The Wizard of Odds on HBO? The Bernie Madoff story?
Yeah. Yeah. The Wizard of Lies. The Wizard of Lies.
Wizard of Lies.
I saw that, yeah.
Not the one with, the one with Bobby D was good. I actually thought the one with Richard Dreyfuss was better.
Which one's that one?
There's two of them.
Really?
Yeah, they did two versions. They were both excellent. I think the one with Dreyfuss was better. I don't remember what that one was called, though.
Are you saying MSTR is not going to go back up? MSTR probably will go back up. The problem is Misty is going to be much harder to go back up to the people's initials. So a lot of times people do that. They'll say, oh, I'm buying TSLY. And I'm like, just buy Tesla, bro. You don't need to do this stupid yield shit that basically all they're doing is giving you your own money back. It hurts. That's all. Whatever.
Yes, you are right. Wizard of Odds is a gambling site.
I've gone to them. I love them.
I may have been on it once or twice.
His presentation on craps is awesome. I love it. You know, me and Steve, maybe we need to do a live stream from Atlantic. Oh, who goes to Atlantic City anymore? Screw that. By the way, is New York still going to get that casino or those casinos?
They approved 3 downstate. SL Green did not get the bid in Times Square.
Mm-hmm. So Caesars is out?
Caesars is out. I think Bally's got one at Ferry Point, but something happened. Supposedly, Steve Cohen is getting one where the old Shea Stadium was, which is not good. We'll see. I mean, I would still rather do Atlantic City than go to a casino here. If they put a casino in Times Square or anywhere in the city where I could just walk there from the office, like that, I can't do it because once I do it once, I'll just go. So I'd rather go to Atlantic City where I have to drive down or drive out to freaking MacArthur and take the freaking junket down. I gotta tell you, taking the freaking plane down from MacArthur is freaking great.
So where do you go from MacArthur?
AC International. It's like a 30-seater. So it's if you just go to flyac.com or something like that, it's like a 30 or 40-seater. And it goes from freaking MacArthur right down there. It's 25 minutes.
Dude, I remember when the Racino thing opened up, they used to have the Resorts World bus pick up all the old Chinese people from like near my neighborhood. Bro, every morning it would come pick them up every evening to come drop them off.
It's right across the street from me.
Oh, yeah?
They have one, yeah.
Yeah, man. And you go there, it's just a bunch of degenerates, bro, just gambling away. Like, the one thing I noticed about Vegas this time when I went, though, was completely empty. And I know we spoke
Everybody
about that.
is saying that Vegas is getting empty.
Yeah.
What do you think about the new tax bill destroying gambling?
I mean, it's not necessarily it's going to destroy gambling. It just destroys professional gambling. So
it's going to destroy me.
Well, I don't gamble, so I don't know, brother. You know, when I go gamble, I go for two purposes: to lose my money, or just to have fun. Because if you think that there's some kind of business around making money with the house edge the way it is, it's next to impossible. And I just have one strategy that I use. Can I
give you the breakdown of how you make money in craps?
No. Well, I mean, you can, but my strategy is more money management. Where what I do is I just take, like, let's say $1,000, I put in my right pocket.
Chad is going to go nuts.
And then I just make bets. And the thing is, every time I win, I take that money that I've won and I put it in my left pocket. And so what happens is, by the time all my money is gone in my right pocket, that's like my sign to just leave. And so what happens is, whatever money I have in my left pocket is what I go home with. So I usually start off, let's say, $1,000 in my right pocket. Most of the time, I've left with more money in my left. And so, you know, because that's the thing, like, over time, the casino always wins, right? So if you play long enough, you're going to lose everything. So I think what it is for me, I just have a very tight system. And I have to watch out for my wife, though. She's a degenerate. Like, I taught her craps, and I think I made a real big mistake because she loves bubble craps. And so anytime we go, she's always just like feeding the machine and push the button. And she's like, so.
That, you know, bubble craps is not real craps, by the way, just saying.
Yeah.
All right. So just give me one moment.
Mm-hmm.
I'm going to pull up a nice picture. So hold on.
We actually won some good money when we went, like, a few times to Vegas. There's this one Monopoly slot game. It was called, I think, like something like Thieves Monopoly or something. But dude, we just had the Mr. Monopoly guy. He just throwing money at us the entire time, and I was like, bro, I'm never leaving. And I think we made like a few $100, like $500-$600 on that machine.
All right. So we're going to use, for you, Kris, a small increment so everybody can follow along. All right.
Wait, there's a Shutterstock. Why don't you just pull up a real, like, craps thing? You know,
This is all.
You sure? Because this one doesn't really show. Just go to, like, what's called virtual craps and just put up an actual game, and you can actually show it. Because hold on. Let me just send you a link to something that you can do. Practice. Here, go to the Wizard of Oz one, Wizard of Odds,
You
and they
put it in
actually
the
have
private?
one on there. Yeah, here, I'll send you the link. Or here, I'll put it in the comment section if you want to take a look.
Yeah.
Oh, failed to send. I'll put it in the private chat.
I'm sure I can just find it.
There you go. Click on it. And there you go. I just sent it in the private chat. By the way, gambling is, we're not teaching you how to gamble. This is Steve's custom way to play the odds, I guess. But
Yes. So it's all math. Okay.
mhm.
It's all math. And this is just for fun. I've never done this before. It's just for fun.
Yeah, just scroll in so everyone can see.
Yeah,
Scroll in
it's just
more,
for fun.
scroll in more.
So we're gonna use
There we go. We've turned from we went from invest in
Mhm.
Verizon because it's safe yield to invest in learning how to play roulette.
So hold on. So Kris, for every $10 you put on the pass line,
Yeah.
you throw 2 on the any crap.
Mm-hmm.
Because any crap pays 7 to 1. So if the
Okay.
pass line loses, you make 14 on any crap. You throw your 10 back on the pass line, your $2 crap bet stays up, and you suck back $4 in liquidity. Now, if a 7 or 11 come out, you lose your $2 any crap, but you get paid 10 on the pass line. So you throw $2 up on the any crap, and you suck 8 back in liquidity because your $10 bet stays up. So it's perfect insurance. Are you using a tin cup, sir?
I think I don't know if it's tin, but whatever.
Are
Yeah.
you drinking soda out of that?
No, my wife made me like a mojito.
I have a special cup that I drink Coca-Cola out of, is a tin cup because it makes the ice colder.
Really?
I'm crazy.
Maybe that's what it is.
I'm
I know
crazy.
I have some copper cups. I think I have to find it for like Moscow mules. I really like that.
Okay.
Yeah.
So we're gonna roll. All right. So no blood, nothing happened with insurance. We're down $2. So now I place. Why can't I gotta do it here? So the 4, 6 we gotta do juice.
Watch Steve lose all his money in just
Make it real.
the first roll, man.
I did it on the wrong one.
Okay, so you lost on the ending craps. That goes away. Your number is a 9.
I didn't want to take all that. I think because I freaking hit the wrong freaking line.
Yeah. So now it's a 9. Wow.
Yeah, it's not staying up. That bet's supposed to stay up.
11. That's 3. Oh, so you're on the 5 right now. 11. Okay.
So basically the idea behind this is, and I'm not going up a unit right now, but I probably could because I'm technically up. So theoretically, a 7 only has 6 combinations of coming out, which is 16.67% chance. When you place these numbers, in addition to having the point, you have 24 combinations of one of your numbers coming out, which is a 66.67% chance. So every roll, you have a 50% edge over the house because you have 24 combinations that could come out versus the house is 6. And the way that the odds are, Yeti.
Yeah, I got 2 things right now. I've got a Yeti cup mug as well. So someone's like, I've got a Yeti cup. I'm like, yeah, me too.
Oh, we hit the point. So see that? We're up on the balance. We could take all the money down, walk away, and we're in the plus.
Yeah.
That's all you got to do. No hard ways, no fields. Come bet is suckers bet. You don't do the come because you got to hit the number twice to get paid. You don't do it.
Yeah.
So that's the way I play craps.
Yeah. Same. Someone said the 6 and 8, $6 increments. That's what I do. I'll do don't pass, and once it gets past the don't pass, just do the 6 and 8, and then if it lands on the 6 and 8, I'll just start covering the 5 and the 9, and then just chill. And hopefully, it's one of those nice long rolls. And if it works out, you get paid good money, and the entire time you're just collecting. So
It's the
yeah.
most fun game in the casino when you're at a good table at night and everybody's just
Mhm.
having fun. It's the most fun.
Yeah, it's a team sport. It's fun. So, like I said, if you go to Vegas, you go for fun. You don't go for, hey, I'm gonna change my life. And you're never gonna change your life at the craps table unless like you have like that Vegas vacation movie where Papa Giorgio, you know which one I'm talking about,
Mm-hmm.
Mr. Papa
Vegas
Giorgio.
vacation.
Yep. Yeah. I still remember you got Garcia addicted to craps, Kris. Yeah, man. I wonder if he still will, if he ever plays. I think he got addicted for like 24 hours and then he lost all his money and then he stopped. Because that's what happens. If you play long enough, you're going to lose all your money. But if you do
You
the
gotta
right
know when to walk
strategy,
away.
yeah,
But
you
my
got to know.
strategy is more risk mitigation. You're not going to make a lot with my strategy because you're not betting crazy odds, but you're going to put the odds in your favor to do the best you can potentially do at the table without just
Yeah.
not playing.
Yeah, let me see if I can craps.
And I do not play blackjack because for over a year I would sit on the subway and I forced myself to learn how to count an 8-deck shoe. And I swear to God, I can't freaking win. I can play perfect basic strategy. I used to be able to count cards. Couldn't win. Stop playing blackjack.
Yeah. So the strategy that I use is a lot more simpler. It sometimes it'll work, sometimes not so much, but basically you just show it. So basically the first thing I do is I'll put like let's say 25 on the don't pass, right? And where's the roll button? Damn it. You see the roll button anywhere?
See what?
The roll button. Oh, roll right here. All right, it'll roll, and so it comes out to 8. So then what I'll do is I'll just cover, say actually not the 5, so I'll do like there you go. So it's a 10. So basically you wouldn't win anything and then just keep rolling. Then this is like
I'm
5.
just looking at this like lost opportunities right now. Killing me. Thomas.
Why?
Because I would have had 10, I would have had a 5.
See,
I would have
it
already
made
had
the 8.
numbers come out.
I lost the don't pass. So let's see. No, go wait. Damn it. How do I take it off?
I'm surprised that these casinos in Vegas are allowing these guys to videotape themselves gambling now.
Yeah, because it brings people in. So now I can't hit this. I need a 7, or I need it to land on the 6 and the 10. So let's keep rolling. 6. So now I'm gonna get paid on the 6. There you go. 4. My wife. See, now it gets 7, so I'll get paid on the don't pass. I'll lose this at the top. So, and basically now I'll have this. So I have to check what because I haven't gone in a while, but basically I put, what should I put, like 10 on the don't pass and then 6 and 6 on the come for 6 and 8. Like, so it's called the 6 and 8 don't come. That's it. Yeah.
Yeah, I can't go dark side.
Yeah.
Can't do it.
Steve, what's your take on Lorcana? That's a Disney card thing.
It is. I don't know. I'm only doing Pokemon, so I don't know.
Yeah. All right. Yeah, so this is what we're basically going to do. I know that some people in the chat today, I don't know what's going on with that Lourdes chick, bro. She's like straight up angry. She's like, how could you tell people not to invest in super high beta growth names? Like, you guys want to invest in Verizon? What's wrong with you? It's probably like, okay, dude. Everyone's got their own investing styles, guys. You know, whatever works for you, just use it. But she was getting a little kind of militant about it. I think she made a lot of money on Palantir, so I think she's one of those people that's just like, I need to always find the growth names. And I'm like, okay, that's fine. That's
There's nothing wrong with that.
Yeah, no, totally fine.
Nothing wrong with that.
Totally fine. Yeah.
I need growth to keep going. Like I'm in growth companies. I
Yeah,
need
me
SoFi
too.
to crush on Tuesday.
What's your main growth companies right now?
SoFi right now. SoFi and
SoFi is
Palantir.
your growth. SoFi, SoFi and Palantir. You still have your covered position on Palantir, so you really want it to still go up?
I have shares that are uncovered, but
Okay.
I have more covered than not, which is a problem.
You know, people, if only people knew the way to play options on certain companies like Carnival Cruise Lines. A lot of people say, "Oh my God, cruise lines, like that's not where you want to be." And I'm like, if I showed you like the amount of portfolio returns I've made on the cruise lines, it's pretty insane. It's just you have to know how the mechanics of options works, how the options work, and how if you do it right, there's a lot of mispricing. And if you can take advantage of that mispricing, you can do very well. And you don't have to be exposed to super high beta names, So yeah. I think we can end it here.
Yeah, yeah. All right.
Yeah.
Well, appreciate everybody watching. We're planning on doing this every Monday night, and we're going to focus on a different company, max two, but probably one company a night. So see how it goes.
Based on today's sentiment, I think it's going to be I think it's going to be hard to do this segment because I don't know if a lot of people are going to value what we're trying to provide right this second. I think a
Well,
lot of
we'll see what happens.
Yeah, I think a lot of what we're going to say in the short term is going to look real foolish. I mean, that's just my understanding of it.
Good.
Because because right now we're talking about something like Verizon. So it feels like, oh my God, like we're in the AI bubble, boom right now. So why would I want to be in a company? And I feel that's actually the right mentality for certain things. But
Look at
I think
Salesforce today.
yeah, it was up almost 5%.
Yeah.
I feel like maybe next year, if like the market does turn, I think a lot of people will finally like be like, wait a second, maybe I should have looked at something with more safety. I think right now we're gonna look like assholes. It's just how it is. I I can't believe the amount of hate Buffett is getting right now. I have seen everyone like on Twitter, they're like, dude, Buffett has lost it. He doesn't know what he's doing anymore. He's basically buying these crappy small companies. I'm looking at Buffett. I'm just like, bro, the Oracle's Omaha has basically beat the market, like handily beat the market for decades. And all of a sudden now, everyone is just like, Buffett doesn't know what he's talking about or doesn't know what he's doing. What do you think about that?
Look, I have a take on Buffett that people aren't going to like.
What do you think? I'd love to hear it.
All right. I think I'm gonna preface it with nobody is going to build what Buffett built ever in our
Mhm.
lives. Okay. You're going to have much bigger companies like an Amazon, a Tesla, a Alphabet. That's not what I'm talking about. You're not going to have some guy go buy a textile mill and then end up owning 50 or 60 actual underlying companies in that portfolio and then purchase and end up owning $350 billion worth of actual public equities in addition to hundreds of billions of dollars worth of bonds. You're never going to see this again. So, from a business standpoint, the guy's amazing. Maybe the best businessman of all time when it comes down to it. But, and there's a big but, a lot of his success came at a time when the market had much fewer companies.
Wait, no,
And
no, 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 no. Hold on, hold on.
hold on, hold on,
Buffett, there were
hold on,
way more companies back then there are
hold on,
now, though. Yeah, go
hold,
ahead. Go ahead.
hold on. There were much fewer companies in the 60s and 70s.
Mm-hmm.
Okay, because that's when he was buying Coca-Cola and stuff like
Mm-hmm.
that. Now, I can think that he's one of the greatest, if not the greatest businessman of all time, and think that he became an overrated investor that was trading on past credibility. And while he was still doing good, he missed almost every good investment over the past 20 years. Never invested in Amazon. His shares of Amazon were not him. He never invested in Alphabet. He never invested in Meta, never invested in NVIDIA. He only invested in Apple because of Carl Icahn. I mean, he never invested in Microsoft. Like, all the names that have done huge in the technology era, he didn't invest in. So while he's amazing, and he may be the best investor of all time, there's a point where it's diminishing returns, where there are other people, I'd say from 2010 or 2012 on, that I would have rather listened to than Buffett, but I would have taken Buffett all day, every day from, say, 2010 previous to 1960, something like that. Amazing, but not relative right now.
So June said 5 Chinese trading companies he bought into have done very well. They're Japanese companies. They're trading houses in Japan. So basically, he convinced them to buy back their own shares. So just FYI, they're Japanese. I think with Buffett, it's all about being able to stand the test of time that you got to give the guy. You know, I think that's what it is. It's one thing, and for him, he's always looking for those pitches, you know, those fat pitches, as he says. He's like, I don't have to swing at every pitch that comes my way, you know. So I think in that regard, I mean, you saw the loan shark deal terms that he had during the 2008 financial crisis with these guys.
How do you think he owns so much Bank of America?
You know, that's how he never loses, because he waits for you to make.
And that's why he's the greatest businessman of all time.
Yeah. Yeah. Well, the entire market was down 50-60%. He came out there. He got crazy warrants. He got a crazy preferred equity return. I mean, I saw the deal terms that he had. It was insane. I was like, bro, Berkshire is not going to lose a penny, and they're going to get a crazy return without lifting a finger. That was how Buffett did it, man. He played the 2008 crisis like it was nobody's business, man.
Right, but let's just say that he was 80, not 95. And let's say he had another 15 years ahead of him, okay? Mm-hmm. Would you be following his plays, what he's doing now, or would you be following somebody else? Because knowing that he's not invested in tech or doesn't care about tech, he's not going to outperform a lot of these guys. Certainly not outperforming us.
I don't know. For me, there's certain limitations that Buffett has with his size. I mean, look at the amount of money that Berkshire has. So when they go out and they buy, they can't just buy into a position and then get out of it within like a quarter or two. Me and you, we can do that. You know, we can be tactical. He can't really do that. So I don't know. I mean, I think value investing.
He's in a different game. He's in a much different game, and I get that. But when I look at Berkshire's portfolio, it doesn't excite me.
Why don't you pull it up? Let's analyze it. Let's take a look. I have it here if you need it.
Where'd you go? Oh, Kris hit the wrong button. Kris will be back in a sec. He definitely went to share his screen. Here he is. I just said to them that you definitely went to share your screen and freaking.
Yeah, just put me on the other side.
Yeah. Hold on.
I'll never understand his play on Oxy. Like, that's the one that always gets
me. I have a take on that. Oxy, in my opinion, is divesting their chemical business because Berkshire is going to acquire them. And they're going to fit their upstream right into Berkshire Energy.
Yeah.
So, Apple, no complaints there, right? Nope. American Express, no complaints there. American Express, amazing company. Bank of America, I own some. Coca-Cola, Chevron, I like both of them, but is Coca-Cola and Chevron my number 4 and 5 pick? No. Moody's, come on.
It's a cash flow business, man. Moody's is a cash flow business. Come on, it's a cash cow. What's their expenses? What's their? It's great.
But is Moody's your number 6 pick in a portfolio?
No, fuck no.
Okay. Oxy, is that your number 7? Kraft Heinz, is that your number 8? Chubb.
Yeah, I would put Chubb. Chubb it's an insurance business. He understands it. You know?
I don't hate Chubb, but once again,
Yeah.
your ninth pick, I mean, I don't know. Verizon, Kroger. I mean, Kroger's a freaking 2% profit margin.
Yeah.
I like Visa. Sirius, I don't know why he owns it. I like MasterCard. Love Amazon. Constellation Brands.
He
Not a
actually has
no-go.
Amazon? Where?
Hmm?
Oh, yeah, he does have Amazon, huh?
Yeah. One of the
Interesting.
other guys in the portfolio bought it.
Okay.
I
He
mean,
picked the one mega cap that underperformed. Well,
right.
two actually. Apple is at the top, so it's fine.
UNH, he just got in.
Yeah.
Capital One, I didn't even realize he owned Capital One. I'm surprised to see Aon in here.
Hmm.
Domino's, Ally Financial, Pool Corp. Like, you tell me you would buy these names?
Well, the one that I'm wondering if he's going to be holding next quarter is Ally. So with all the contagion that's in the ABS market, I wonder how Ally is going to come out. Same thing with Carvana.
When did he buy Atlanta Braves Holding? When the hell did he buy that? That's got to be new. That was not in there.
I mean, it's barely anything, so who
Yeah,
cares?
but still.
That's a John Malone play, I think.
But
All
in
the
all
Liberty stuff,
seriousness,
that's John Malone.
I get it that these are very small positions, not even 1%. But are you even putting money in these things? You know what I mean? Like, are you putting freaking 1.5% in Kroger or Verisign?
I mean, I'm putting money in Verizon, bro. I mean, that's pretty much what. Yeah.
I don't know.
I don't know. I don't know either, man. All I know is I'm waiting for some good deals to come up too. Like I'm looking at, you'd be surprised, but I'm actually looking at the cruise lines. I'm looking at Norwegian.
I'm
Norwegian,
not
if you want,
surprised. You love cruise lines.
they're a cash business. They generate a ton of revenue, ton of
Well, look,
operating
your
income.
thesis is right when rates come down on them. So your thesis is right on that.
They've got 3 tailwinds that is insane right now. Okay, number one, interest rates go down, they make more money, right? Because they have debt on the balance sheet. So number one, that's big point catalyst number one. Number two, Trump is all about keeping oil prices low. One of the biggest costs for the cruise lines is what? It's their fuel, right? If you look at their margins, it's like 10%. So if you can save 2% on margin from that, you get 12%
Yeah,
margin.
it's big.
Right? So it's huge. So fuel costs are lower. Growth, they have a bunch of new ships that are coming out, and they're solid booked all the way until 2027. You look at the booking schedule, these guys are charging way more because there's just so much demand. And the thing is, the build outs are not elastic. So it's not like you can just say, hey, let me get 20 more ships today. Like, even from a competition standpoint, it's not that much there, you know. Then you have all these additional increase in private islands. Thank you. Raven knows. They do well. Yeah. Kris loves the cruise line. I bet in his past life he was a pirate. Maybe.
You could have been a pirate.
I am a pirate. Going after these shitty companies no one else wants to buy. All right. I think that's about it for today.
Yeah, we'll call for the night. Thank you, everybody, for joining. We appreciate it. And we'll see you next week.
Yeah. Later, guys. Have a good one. Bye.